The last type of security that we're going to look at in the theoretical part of our course is the futures contract. In general, futures contract is an agreement to either buy or sell a specific commodity, for example, gold, wheat, coffee, etc., on a specified date in the future at a predetermined price. All futures contracts have a specified lifespan and usually expire within 1 year, although some may have a life of up to 5 years. Each contract covers a certain quantity of its underlying commodity, for example, 5,000 bushels of wheat or 112,000 pounds of sugar. Now, futures work much in the same way as options, having long and short positions. Investors never actually deliver or take delivery of commodities. So how does it work? Well, if an investor enters a contract on the long side, for example on one wheat contract, they are saying that they want to purchase 5,000 bushels of wheat at some point in the future. The investor watches the market. If and when the price per bushel is favorable to their position, they enter a contract on the short side to sell 5,000 bushels, thus closing their initial position or canceling their obligation to take delivery of the wheat. Now, to enter a futures contract, an investor pays a fraction or margin of the entire value of the contract. As the price of the commodity changes, the investor's account is either credited or debited, depending on their position in the market and the current value of the contract. It should be noted that futures contracts are listed according to the month they expire in, for example, March wheat or September coffee, and each contract expires on the third Friday within that given month. Now, a futures contract can cover the following: agricultural goods, such as cattle, coffee, cotton, etc. Natural resources, like copper, crude oil, gasoline. Foreign currencies, such as the English pound or the Japanese yen. And fixed income securities, such as euro dollars or treasury bills. And market indices, such as the S&P 500 or the Russell 2000. Now, the trade of futures is carried out on the following exchanges: Chicago Board of Trade, Chicago Mercantile Exchange, the Mid-American Commodity Exchange, the New York Mercantile Exchange, the Coffee, Sugar, and Cocoa Exchange, Kansas City Board of Trade, Minneapolis Grain Exchange, New York Futures Exchange, New York Cotton Exchange, and New York Mercantile Exchange. Now, the way that we determine the price of a specific futures contract is as follows. The contract price equals the price per unit times the number of units per contract. Each contract has a given number of units, as was mentioned. A listing of units and number of units per contract for various commodities is included with this course. Now an example. This will be for a futures contract on wheat. Units, in this case, equals bushels. And 1 bushel's current price, let's say, is 350 cents or $3.50. One contract covers 5,000 bushels. So the cost of the contract is $3.50 times the number of units in a contract, 5,000, totaling $17,500. There are two general groups who trade futures contracts: speculators and hedgers. Speculators are those investors who wish to trade contracts without actually giving or taking possession of the underlying asset. They seek to make a profit by either buying low and selling high, or selling high and buying low. Hedgers are those who are engaged in the actual buying and selling of assets, such as farmers who grow wheat, or a bakery that might buy wheat. In the case of a farmer, they hope to get the best possible price for their product, and so through a futures contract they fix a price. If over the course of time the price on the open market drops, they're protected. The reverse is true for the bakery that buys wheat. They want to pay the lowest possible price, so through a futures contract, they protect themselves from a possible increase in price. Now, an example of speculation. In this case, we'll be dealing with a futures contract for the S&P 500 index. In this case, units equal points, and 1 point equals $250. Units per contract equals the current number of points listed on the index. So, a trader, believing that the common stock market will move upwards, purchases a long S&P 500 futures contract when the index is at 950 points. This contract is worth 250 times 950 points, totaling $237,500. The investor pays the fixed initial margin, or performance bond, for the contract of $12,563. Now, when you enter a futures contract to buy a commodity, it's called a long position. When you enter a futures contract to sell a commodity, it's called a short position. Now, let's say our trader was correct and the market increases. The S&P 500 index moves up to 960 points, at which time the trader closes their position by entering a short position. This procedure is called a reverse trade. The short contract has a value of $240,000. Therefore, the profit will be $240,000 minus $237,500, which was the initial contract value, equaling a profit of $2,500. Another way of calculating this is you take the points, the current 960 minus the initial 950, equaling 10 points. Multiply that by $250 per point, totaling again $2,500. Now an example of hedging. Let's say a corn farmer notices that during one of the winter months the price for July corn is $2.95 per bushel, and this price is considered to be good. Well, if the farmer does not want to wait until July to make a deal to sell the corn, thinking that the price might go down, this individual could enter a short position on a July corn contract, in effect locking in the price for which the corn will be sold. Even if the corn drops in price to $2 per bushel, the farmer can still sell 5,000 bushels at $2.95 per bushel. Another feature of futures contracts is that they are not directly formed between the buyer and seller. There always exists an intermediary or clearinghouse. Therefore, the process looks like this. First, the buyer promises to pay the cost of the futures contract to the clearinghouse. Second, the clearinghouse promises to pay the cost of the futures contract to the seller. Third, the seller promises to deliver the assets of the futures contract to the clearinghouse. And fourth, the clearinghouse promises to deliver the assets of the futures contract to the buyer. Thus, the clearinghouse exists not only for the regulation of the market, but also acts as a guarantor both for the buyer and seller. Now, as was mentioned before, there is no need for a trader to pay the full value of a futures contract for opening a long or short position. The buyer, owner of a long position, and seller, owner of a short position, need only pay an initial margin or performance bond. As a rule, the value of the margin is only 2 to 10% of the total value of a futures contract. So as you can see, when trading futures contracts, there is a phenomenal amount of leverage. Now, let's look at an example of leverage. Let's say a trader buys a long position on an S&P 500 contract when the index is at 950 points. Therefore, the total value of the contract is $237,500. However, the trader need only invest the initial margin or performance bond of $12,563. At the end of the trading day, let's say the index has risen to 962 points. So the trader's account is credited with a profit, $3,000. Thus, the initial investment of $12,563 has brought a one-day income of $3,000 or a 24% return on the initial investment. Now, futures transactions are conducted as follows. At the end of each day's trading session, all accounts are adjusted to reflect the changes in the value of the contracts. An investor's account is either credited or debited according to the change. This is called marking to the market. A trader's account reflects the closing points, or price for that day, the actions taken, such as the opening of a position, the initial or maintenance margin, the profit or loss is determined by marking to the market, and the balance of the account. You'll notice that there are two types of margins. The first type is the initial margin. This is the amount needed in an account to open a position. The second type is the maintenance margin, which is the amount needed in the account to keep or maintain the position. As a rule, the maintenance margin is not less than 65% of the initial margin. If there is a loss, which decreases the trader's account to less than the maintenance margin, the trader receives a market call, which means that they must place enough money in their account to bring the balance back to the level of the initial margin. The amount needed to bring the account to its previous balance is called the variation margin. In the event that the trader has a profit rather than a loss during a given day, they need do nothing save sit back and smile.